Hi, I'm Saba Yasmin with Realty One Group Central, your trusted real estate partner in New Jersey. Today, I'd like to discuss the latest financial data from the Bureau of Labor Statistics, the recent decline in mortgage rates, the Federal Reserve's expected rate decisions, and what all of this means for the housing market. The Fed is widely expected to begin easing, and markets are pricing multiple cuts. Different polls show a September cut is very likely, and the market now expects multiple reductions through year-end. That's good news for the housing market, but let's break down why and what it really means for you as a buyer or seller. The BLS reported that the CPI rose 0.4% in August and is now 2.9% year over year. Core CPI is running 3.1% year over year, still above the Fed's 2% goal. That complicates the outlook for long-term rates. Producer Price Index shows mixed, slightly cooler pressure at the producer level, which supports the case for easing. The labor market is softer than earlier in the year. Unemployment ticked up to 4.3% in August 2025. Weakening jobs support Fed cuts even if inflation stays stubborn. Mortgage rates have already reacted. 30-year fixed rates have fallen noticeably. Freddie Mac's commentary shows the 30-year dropped 15 basis points to 6.35% in the week of September 11th. Expect mortgage yields to drift lower if the Fed cuts, but not necessarily one for one. Let's understand how monetary policy translates into mortgage rates. The Federal Reserve controls the federal funds rate, which is the interest banks charge each other for overnight loans. This directly affects short-term borrowing costs like credit cards, auto loans, and adjustable-rate mortgages. A 30-year fixed mortgage isn't priced off the Fed's short-term rate. Instead, it closely follows the 10-year U.S. Treasury yield plus a risk premium. When investors believe the Fed will cut rates, they often buy long-term treasuries, which pushes yields down. And mortgage rates tend to fall as well. Inflation expectations are critical. If inflation is high or sticky, investors demand higher returns on long-term bonds, keeping mortgage rates elevated even if the Fed is cutting short-term rates. When inflation trends lower, Treasury yields and mortgage rates usually decline. If the Fed cuts 3 times in 2025, what to expect for mortgage rates? Near term. Markets often front-run Fed moves. If the cuts happen and job data remains weak, 10-year Treasury yields could move down further, and 30-year mortgage rates could fall another few tenths. Aggregate movement could be 25 to 75 basis points from current levels, depending on how yields and spreads behave. My advice for buyers: if a buyer is mortgage rate sensitive and the home meets needs, lock as soon as you have an approved loan and are under contract. Locks protect against market reversals and real short-term volatility around Fed announcements. If you can wait and are not under time pressure, a conditional strategy works. Keep pre-approval in place. Watch the market for 1 to 3 weeks following each Fed move, and be ready to lock if rates dip to their target range. If rates fall significantly, buyers who waited might regain purchasing power, but inventory and local competition will matter too. For cash buyers or buyers with strong down payment, lower rates increase demand, so be ready for more competition if rates fall. Consider escalation clauses for desirable properties. My advice for sellers: be aware of demand cycles. Lower mortgage rates typically bring more buyers back into the market. If we see 3 cuts and rates drop materially, expect more buyer traffic and possibly stronger offers in 6 to 12 weeks after cuts as confidence rises. If you need to sell now, don't rely on further rate declines to improve your sale prospects. Price and presentation matter. If a seller can wait a couple months and the market tightens, they may get better terms. But this is a trade-off with carrying costs and uncertainty. Prepare for increased buyer scrutiny. If rates fall and buyers return, those buyers are often comparison shoppers. Ensure your listing photos, disclosure package, and inspection readiness are top-notch to capture demand quickly. The bottom line, rates are likely to ease, but the exact path isn't guaranteed. Whether you're buying or selling, timing and strategy matter more than ever. Let's talk about your timing, budget, and goals so you can make the best move. Saba Yasmin, Realty One Group Central, 609-232-2645, saba.yasmin.realtor@gmail.com.